little tutorial in case you guys don't know. I'm sure you guys are all familiar with Zoom, but down in the lower left-hand corner is your video stop and your video controls, and also your microphone for muting and unmuting. Those are the two things that we're probably going to do the most here. And then Jean may share her screen or so. And then
the chat as well.
What's that?
The chat.
The chat. Okay, yes, the chat. On the there's a chat button at the bottom in the middle, and if you hit that, we'd love to have you put your contact information in, your email, your phone number, and a little bit about yourself so that we can put you into our directory and we can get the information out to everybody so that we can all do business within the group together, as well as make referrals outside the group for any things that somebody might need from the group. So really important for that. And then let's see, real quick, let me introduce my crew. I'm down one crew member right now. So she's normally with us, but she's getting close to having a baby. And so she's out right now. That's Serena. But starting with Caitlin is my daughter, but also my marketing executive extraordinaire. So there's Caitlin, and then I've got Terrell, who is, right now he's my doc's dog, but he's getting ready to get licensed as a loan officer. I think his test is coming up at the end of this month. Is that right?
Yep. Trying to get ready.
I think he's about as ready as he's going to be. He's got the stuff down pat, so he's doing really well. So, Caitlin, did you want to say anything?
Well, I can introduce myself.
Yeah, there you go.
My name's Caitlin. I do the marketing. I run the Facebooks. Wow. The business pages, the Google pages. I send out all the directories. There will be a survey entered in the chat. So if you guys could copy that link and complete that survey, just kind of about the meeting and like what you think and what you want to see more of, that would be good. Yeah, so I kind of co-host this shenanigan, and yeah, it's fun. I've only been doing this for about a year to the day, actually. So I'm pretty new.
Yeah, but you got it together, so you're good. You're good. Terrell, did you want to say anything?
No, really, I was already introduced, so welcome. Thank you guys for coming, and hello.
Oh, and his setup, I went and actually looked at his new office setup, and his setup made me jello. So I guess I'm gonna have to get onto Amazon and see if I can compete a little with the dude. So anyway, the main purpose of the meeting is so that we could just all come together, share our experiences, share our knowledge, ask questions, get questions answered, and hopefully grow and expand upon our endeavors, if you will. So that's kind of the point. Just a self-help group, everybody come together, and there's going to be a lot of different pathways that are used on this. So everybody can learn something. I guarantee you. I can't wait to ask a few questions to Jean, because I've got situations and I don't know some of these answers, so I know Jean knows the answer. So I'm anxious on that. So I'm going to run around the group. Rick, do you want to introduce yourself?
Sure. Rick BML. Let's see here. Full-time state worker, part-time investor, although sometimes it seems like it's the other way around. So have completed a complete bird deal in Hoquiam, and now I can say it is complete. The refinance just finished up, and then let's see here. I'm working with Dennis on a flip. We originally were looking at making this into another bird deal. We had some scope issues that we're dealing with, and so we decided to employ our backup strategy, which is to flip the house. We'll still make a pretty good penny on it. So actually, I think from a dollar standpoint, we'll actually end up ahead of the game as long as we can get her completed sooner rather than later. So
Have you
already
noticed-
starting to look for another deal.
Have you noticed values in the area going up a fair amount, like in a short period of time?
So I've kind of watched that, and yeah, I saw a nice, great big spike over the summer, and then things have kind of settled down. So just like with my other business, you have spikes and ebbs and whatnot with what goes on, and real estate isn't much different than that. It has the normal peak season, and then it has the down season, and wintertime is typically the down season, and you'll typically see price drops and things stay on the market longer during winter. I'm not seeing the same kind of deals that I did when we first started last year, as far as the entry point for price. There's a couple of them, every once in a while sticking out there, but they're big projects to do. The prices haven't fallen, but they're not rising at the same level that they were. I anticipate that will change probably around March, which is the normal, when things start to uptick anyway, when the inventory gets bigger. And I'm going to start seeing, I'm confident we'll start seeing prices increase at that point as well.
Good. I know each area is definitely different, and so it's always good to kind of keep your finger on the pulse of what's going on, and especially in that area, because that's kind of that's the new staple area for everybody right now. It seems like because they just were priced out of so many other areas. But Dennis, do you want to introduce yourself?
Yeah, hi, I'm Dennis Hamlin, partner with Rick. We are just trying to get to the finish line, trying not to make any major issues as we get there. I think if I was to throw something out there as far as this project goes, that it would have been different if we would have been going as for a flip from the beginning instead of trying to do a burr. And I think that those decisions are really important. But I think the most thing that I'm learning in this process is that your starting point is really important, that you kind of know where you're going. It's hard to change in the middle. I'd say that's my big take right now from this process.
Yeah, I'd agree with that, Dennis. One of the things that we saw is that, and I mentioned earlier, we saw some scope change, and if we would have kept our focus on the burr model, which is what our original intent was, we would not making the changes in scope probably should not have happened, where we had to switch our focus. So now that we increased the scope as far as what we're doing to the rehab, it was starting to get to a point where, well, wait a minute, this is extra work, extra money and whatnot. And so now in order to rent it out, we'd have to charge more than the market could bear to rent it out. So flipping it over to making a flip, if we would have made those decisions up front, we would have probably made a few different decisions along the way.
And
But,
I only say
lessons learned.
And I only say that just as FYI, for everybody, and when you're doing a deal to get your baseline down. This is my first one, so I'm giving myself a break a little bit and giving Rick a break because he was doing the burr. So you know, more. I only bring it up so that it can be information to be used by everybody. You know, and that's it. It's not. I've put the bat down. I'm kind of holding on to it.
Well,
But
you can let go of it. You can let go of it now.
I'm not using it like I was a couple weeks ago. Let's put it that way. But you know, and so it's just information. That's all it is.
What,
So
what
we
I would
want to
ask,
make
that
sure
leads-
that you guys learn from our mistakes.
Correct.
sounds to me like what you're saying is that maybe the materials were less, maybe not quite as high a quality as the flip would be, or there's just more elements that you took on with the flip as opposed to the burr. Does that sound?
More elements, I would say, is probably where it's at. Having to
Yeah.
make things look much more better to sell than to rent.
As
Right.
an owner occupied versus renting.
Yes.
Okay.
First, I'll give you first big decision point that kind of changed that direction is that we chose to take out a load bearing wall that would open things up and quite appealing. For somebody that's buying a house, people are looking for a nice open concept home, really nice and pristine, and you can see the view all the way from the front door all the way out to the back door, and you can see the river from there. Great. But that decision comes with some costs. And then, of course, if you're going to do that, then you're going to have to upgrade the fixtures. You're going to have to upgrade, these other items that if we would have stayed with the original focus, no, this is going to be a burr. We're just going to turn it over as a rental and get just enough to get our money back so we can repeat it. Not what we ended up doing is just pricing ourselves out of the rental market.
Yeah, I definitely understand. Definitely. Well, good information, guys. Lane, do you want to unmute and introduce yourself?
Hello, I'm Lane Boucher. I'm a realtor. I'm a property manager. And we started flipping houses last year. We are on number 4, technically. 1 in Yakult, 1 in Portland, 2 in Vancouver. I'm a dad. I love what I do, and I'm here to learn.
When you guys started, it was you and Shane, but then you brought on a partner recently. You want to elaborate on that and kind of how that's worked and how that feels so far?
Yeah, so we just all have skin in the game. So we have Shane and I, which are investors, and then Justin, who is a contractor. We have basically let him into the split of the profit as a partner, and that gives him incentive to cut costs and be transparent. And so we have 2 contractors now, actually, another friend of mine, so I'm trying to build a team of people that are as interested and they have as much skin in the game is not really as much, but just enough to keep us all. We all have the same kind of mentality, like-mindedness, work ethic, goals, and we work together to make that happen. The Portland flip's going great. It looks really awesome. It looks like the market's going to be a little bit higher than we expected. Good thing, because it's costed us a little bit more than we thought. We were thinking around the 400 range. I think we're going to get 425. I take my Oregon test again Thursday, so hopefully I'll have my license in Oregon to list the house. or I'll take it again. I don't know. I only missed it by one question last time, so hopefully I'll make it this time. But yeah, we're just trying to build a team of people that want to, generate some business and earn some money. And
So question for you, Lane. On a high level, without getting too much into the detail, how did you kind of structure that partnership, bringing the contractor in and giving him some interest in this?
Equal partnership. So Shane and I started on the first one. I was his realtor. He was the person buying the flip. He flipped it. I bought it with him. I sold it with him. And then we took those funds and we put it into the next house together as partners, and we split the profits on that one. We made $12,000 before taxes in 4 months each. And then we put those profits in, and we found another house in Portland through a wholesaler. And then Justin, the contractor we brought in to, it just seems logical to have a good contractor on your team and dedicated to the work of your business rather than, he's focused on us 80 to 90%. And then he has his side stuff, of course. And we're all friends. So it doesn't matter what we're putting in, is the way that we look at it. It doesn't matter how much each person, it doesn't have to be an equal amount. We're not trying to split hairs. We're trying to build a team with the same goal and see that progress. We want to we're talking about moving into like recovery housing. That's a meeting we're going to have soon with the place called Clean Street, and it's a government-funded program that will give you money to prepare and manage housing for them. So we're looking at that arm of things, as well as flipping houses. Justin happens to be affiliated with Clean Street, which was how he started his contracting business, and so we're blending those together. To kind of, there's the increase of government grants for recovery housing is insane right now. And so anywhere almost in the country, that's why we're looking outside of the state right now. Anywhere outside of the country, outside of the state. If you can find housing and secure the government grants for that, then your cost is lower in other counties, and you still get the same cost per room in the grant. So we're still in the beginning of that. So that's one thing we're working on. But the main thing is that, your question was, how did we come to the agreement? Is that what you're saying?
Well, how did you structure the agreement? Did you give the contractor an equal share? So now it's 1/3 each. But now you're not. But now you're only paying material costs.
We're not. So the contractor put in about $10,000 up front as part of our down payment for the house. And then he has pre-funded some of it and then got the work done. And then we submit that for the draw. Mm-hmm. And we get the draw. And then, if we go over our allotted amount, then it comes out of my pocket, and then that comes out of closing. And so we're really playing it by ear right now. We've literally only finished one flip, which went well, and this one seems to be on track. It's about 10,000 over our original amount, but we did electrical, plumbing, siding, windows, roof, gutters, doors, flooring, everything. We took walls out. I mean, so I think we're going to get 425 for that one, which will give us about 10 to 15 each, I'm thinking.
Awesome. I'd love to talk more about this offline with you. If you could make sure that you put your info in the chat box. I think Dennis and I might have would love to have a chat with you.
Sounds good.
Yeah, fantastic. Clay, do you want to introduce yourself?
Yeah, absolutely. Hi, how you guys doing? Yeah, thanks for having me here. I am new to this whole thing. I haven't done any flips or anything like that. Just doing the YouTube Academy, right? And obviously, well, actually not obviously, but I've been watching real estate in Washington for forever. But I come from the grocery industry, and so only recently, in the past 5 years, have I jumped into computers and actually making enough money to buy housing in the state I live in. And so things have been really awesome ever since then. And I bought my first house this year in June, and I've just been watching everything I can on YouTube about wholesaling. I just bought PropStream. I've been calling leads and nothing's been happening yet. But yeah, so I'm just here to meet folks and see what's going on. And that stuff that Lane was just saying was really interesting to hear, because my brother-in-law builds tiny homes and densifying Olympia and these surrounding areas. That's really like that's going to be really important right now and really popular. And so yeah, it's awesome to be with you guys and to hear all this stuff. So really, I'm just here to learn for now. Yeah.
Well, it sounds like you got a good start and you're headed in the right direction. Lane might be able to connect you up, and also Rick might be able to connect you up with some wholesalers, and maybe you can pick their brain and get some ideas in terms of that. I did some wholesaling way back when, and I had success, but I've been in the lending industry for 25 years. I had to go back, so that's a specialized area, and if you learn the tricks and the trades, you can do very, very well. But as a wholesaler, you got to bring the right property to the person when they need it at the right price. And so there's definitely some ins and outs you got to learn to be able to do that. So anything that can help you get further faster, definitely a plus. Definitely a plus.
I usually have the directories out on Friday, and I take all the information and put it into that. So I saw your email, and I'll make sure that you get added to the list to receive that as connections from everybody that's been in our meeting. And that goes to everybody. It will be sent out to the email that you provide.
Awesome. Thank you. That's going to be really cool, because yeah, this is about networking.
Exactly.
It's about the people you meet and the relationships you create, and hopefully they're awesome and you carry them into the future and make money together. So yeah,
that's the goal.
Look forward to it.
Lonnie, I see that you're on here. You want to introduce yourself?
Well, sure, I'll do that. I'm Lonnie Knowles. I run a service called Concierge of Life, and I'm a personal investor myself, and I work with investors to find their specific needs. I work with the Longview downtowners and the Kelso downtowners, and about 4 or 5 different boards in the area here locally. So or more than that actually. But if somebody has a problem, they kind of usually get a hold of me to start their business, show them how to do marketing, show them how to do all kinds of things. So it's like today in particular, when somebody comes in this area and has a brand new business to start, they'll get hold of me first and say, how do I get involved in the Chamber of Commerce or whatever it is in particular? I help them with that. And right now I've got, I'm looking for some a developer possibly, and maybe some investors, depends on a local deal in Longview. So I have a 13-acre piece out in Longview. Actually, it's going to be zoned out for some houses here very soon. So, but I do all kinds of stuff really. So however I can help out,
Lonnie's been a long time fixture in the real estate business through title companies and things of that nature in the past. And so Lonnie and I have known each other, gosh, I don't even know how many years now.
I think
But,
2008, actually. 2000.
Was it right around there?
Yeah, 2008. So I was working I've worked with architectural companies and with the developers and builders prior to that. But 2008 is when I started working with Stewart Title, and I helped run that and grow that for like, I don't know, however long. I had a massive stroke in 2016 that put me out of the game for a while. So in the meanwhile, I'm just kind of working on myself and helping grow the local community, because I like I said, I love to help with local business. So if I can do that, I do. And people contact me to help them with their problem they have. So if you guys need help with anything, let me know.
So that project in Longview, is it, are you guys going to cut it down to certain lot sizes and that kind of thing, or?
It's the zone for 39 houses at one time, but
Okay.
I'm not quite certain, because there's an issue right now with some sewer, and I've had one of the developers tell me that he has no problem getting around some issues, the city. But I mean, I don't know. I can send you information in regards to that if you're interested, for sure.
Yeah, I'd love to know more about it. I might have some people that would be interested in joining on to build that out. So, I mean, 39 lots, and Longview could really use it, honestly.
Mm-hmm. Yeah, it can for sure. It's in city limits, which is crazy. So, it's like,
that's surprising.
Yeah.
Well,
but other than that, I've purchased myself. I purchased multiple homes. I flipped a couple, and I'm trying to grow rentals myself. So if you know any great rentals, I can definitely pick them up. And I work with a lot of other investors. So that's me. It's me in a nutshell.
Okay. Well, if Naomi gets to a point where she can unmute afterwards, that would be great. And the final person, Jean, if you want to unmute and introduce yourself, and then Jean's also going to do the presentation tonight.
Did we skip Dennis?
No, we got Dennis.
Okay, I just want to make sure you're included.
No.
She's taking it out.
We edited Dennis out. So my name is Jean Falb. I'm an enrolled agent and a certified tax coach. Those are just IRS designations, but they have cool letters behind my name. And I'm going to do a presentation tonight on planning for taxes on real estate. So our lovely assistant, Caitlin, is going to monitor the chat. So if you have questions, please put them in there, and then I'll address them at the end. You don't have to put them in the chat, but if you think of something along the way, and then we'll do questions once I'm done. So how's that sound, Kevin?
Yeah, take it away.
All right, let's see if I can overcome the technology. Can you see my screen?
It looks beautiful.
Doesn't it? Let me move your little faces. Okay, whoopsie, hit the arrow key. So there's my name. Yay. I own Total Tax and Accounting. That's my email and my phone, and that's going to appear in the end. And it's also in the directory if anybody wants to reach out and ask questions. You can hardly see it at the bottom, but I offer a no obligation tax discovery, and that's free. And that's where we help you find your ROI on saving taxes, investing in a tax plan to save on taxes. So the normal ordinary earning cycle of most people, you earn money, you pay tax, and you spend what's left over. What we try to do with a tax plan and advanced tax strategy is flip that so that you earn, you spend in tax smart ways for your lifestyle, legally, of course, and then you pay tax on what is left. And that does take some planning. Some of the considerations of a tax plan, we look at income shifting, retirement planning, maybe you're going to sell, succession planning, business entity formation, and loopholes and credits. It's a big picture when we look at your tax return. Okay, so into the meat of it here. So planning for taxes when real estate is involved can be a maze of complex issues and terminology. And there's lots of investment schemes out there, and people are trying to sell you books and you know, television ads. And so you want to find a trustworthy advisor. This is actually an old slide because we were going to do this in November, but they were having one of these events in Seattle where you're going to get rich if you go to this seminar. So there's 3 labels the IRS uses to describe real estate investors, and each one has its own effect, and it can dramatically change your tax liability depending on which one you are. So I'm going to start with real estate dealer status, and this is defined by the IRS as someone who is involved in real estate as a trade or business, and that's going to be Rick and Dennis in this example, if you don't mind me saying that, because they're buying a house and they're flipping it. And so think of this as a label of the transaction, not of you personally. So when Dennis, he gave me a great segue. He said, we really should have figured out what we were going to do with the property first and stuck to it, is kind of a paraphrase. And that's going to become important when you look at the taxation, because the intent of the use of the property is going to dictate its taxation. So there's 15 criteria. I'm not going to go over all of them. But this is what the IRS is going to look at to determine if you're a real estate dealer. Okay. How willing are you to sell the property? Do you advertise? Do you have an office? Do you have a sales representative? What are your other real estate transactions, and what are your other real estate holdings? There's more than this, but generally they're trying to get a feel for what is it that you really do with real estate. So out of that criteria, the most influential one appears to be the frequency of sales. So if you're selling a lot of houses, and the purpose for acquiring the property. So they're looking for properties that appear to be primarily held for sale. If you're treated, and here's why. If you're treated as a dealer, then the real estate income from that property is considered self-employment and is subject to self-employment tax. You're not going to be in the depreciation world. It's a whole nother way of doing business. So that's, you know, it's basically double taxation with self-employment and self-employment tax and income tax, and whatever gain you get is not going to be a capital gain like it is when you sell a rental property. And generally capital gain is a better rate than your income tax. Sounds fun, doesn't it? You want to run out and do that, don't you, Clay? So the best defense against this is being deemed this status, especially if you're under audit, and specifically to minimize the self-employment tax is to do an entity analysis to find out what's the most advantageous way for you to operate this business. And oftentimes it's through a separate entity and using tax planning strategies to reduce that tax. You can also you should also consider segregating multiple properties. If you hold rentals, they should, you know, be over here in this LLC, and you want to segregate those so that the IRS doesn't pick and choose. Well, this one looks like a dealer, this one looks like, because your taxation is going to be dramatically different. So when you're ready to sell, you're not eligible for an installment sale like you would be on a rental if you wanted to sell a rental on an installment sale where you're holding the note. So I guess you can, but if you do that, you recognize the gain of, excuse me, not the gain, you recognize all of the income when that transaction occurs, even though you haven't got all the money because you're letting them pay you back.
So real quick before you leave that, because I'm going to forget the question. So you're saying that if you're in a dealer status, you cannot sell, or you have to count all the gain in the year that you initialized or completed the deal, as opposed to if you sold and it was a rental property and you would just take each dollar amount that you got year over year. Is that right? Did I get that right?
Yes. And so in this scenario, it's all self-employment income and it's the full amount of the sale. you sell your rental property, and you're spreading that gain out over the length of the installment note. Does that answer your question?
It's good to know. Yeah.
It's a nugget, isn't it?
Yep. Got to have them.
Real estate developer, Lonnie. You probably already know all this. So this is also identified on a per property basis, and developers or real estate investors who are in the business of producing inventory. So as such, you're subject to uniform capitalization rules, yawn. So you cannot deduct depreciation, and all of your carrying costs are subject to capitalization. All right. Basically, this just means it all gets piled in a spot on in your financials, but you don't deduct it until you sell. So if you have a 5-year project, that can get kind of expensive. So direct costs, materials, labor, mortgage interest, property taxes, all of that goes into what they consider inventory, because what Lonnie is doing is creating inventory by having one piece turned into 39 lots. Thank you for the example, Lonnie.
Yeah, no problem at all. By the way, so I don't already know this. I know as little as possible on everything I do.
Okay,
I just know everybody who does it. So if
all right.
as long as I know the right person, I'm great. You know what I mean?
So again, this uniform capitalization, that just means it's going into a parking lot of inventory on your financials. It's not deductible. So labor, benefits, storage, insurance, utilities, engineering costs, tools, it's not inclusive. There's a longer list, but there are a handful of categories that you can deduct. So you'll want to work closely with a tax planner to make sure you're making the most of those to help you, your cash flow as you go. The coveted real estate professional status. And the biggest tax benefit to investing in rental real estate is, as you know, the ability to offset your losses created by depreciation against other income. It's not quite that simple, but that's the principle. And that's really the loophole that most real estate investors enjoy. This income, the activity is generally considered passive, even if you materially participate. This makes my head spin, so I would admit yours might too. There's an exception to what I just said if you qualify as a real estate professional. And you might say, well, I'm a broker. That makes me a real estate professional. And it's not that clear cut. You might be, but it's not that clear cut. So the IRS is changing their interpretation of the law and challenging even some full-time brokers in their claim of real estate professional status. So now more than ever, it's important to understand all of the elements and the documentation you want to have to satisfy the requirements. In the real estate industry, there's the saying location, location, location. And I, as your tax coach, I'm going to say documentation, documentation, documentation. That's going to be what you want to focus on. In order to have real estate professional status, you have to meet a two-pronged test. If you're generating income, there will be the same scrutiny as trying to deduct a loss. But for sure, if you're trying to deduct a loss, you're going to pay more attention to it. Exactly. Any type of loss does not offset any type of income. There are very strict ordering rules. So if you have losses, you want to work closely with a planner to make sure you can take tax-free income that those losses would allow. An example is I had a client come in for a tax plan, and they had $113,000 of suspended losses. And so I came up with a plan how they could go ahead and generate income tax-free to use those losses. You have to take some steps to do that. So you have to spend more than 50% of personal services in all trades and businesses during the tax year on real estate activity. So if I have rental properties and I have a full-time tax practice, I might have problems meeting that test. Okay, so that's what they mean, all activities. And this time must be spent in real property trade or business in which you materially participate. So you have to spend more than 750 hours of service during the tax year in this real property trade or business in which you materially participate. So sometimes you get in trouble, and this is more important when you have a loss, but if if you have a full-time job or you're working 60 hours a week, it might be difficult to convince the auditor that you have enough hours and not sleep, to do that. So again, this is the documentation. And then if you have to have at least 500 hours per year on an activity to be considered non-passive. That's important because non-passive income can offset against wage income, for example. There's that ordering rules. It depends on what kind of income it is. And it's just not, I've got a loss over here and I've got a plus over here and I can offset them. Not sure I want to read all of this. And but you have to more than 500 hours a year. Your participation in the activity has to be substantially all of all the individuals who are involved in this. Yours has to be more than 100 hours during the tax year. I'm not actually going to read these all word for word. You must have materially participated in the activity for any 5 during the 10 years that immediately preceded. This is IRS speak. And then also we have the awesome fallback that the IRS does based on facts and circumstances. So basically you have to be on a regular, continuous, and substantial basis during the year, be participating in this activity. Having fun yet, Clay? Your brows are all knitted.
Yeah. Oh, I'm in way over my head. Absolutely.
It's okay. There's no test.
Some of these
That's
words,
okay.
but not in
That's
your
what-
context.
No, there's no test on this. So we're going to have an example. We're going to say Clay is a real estate agent and he spends 1,100 hours acting as a broker. And so he's doing real estate purchase and sale transactions. And so on the surface there, Sam qualifies as a real estate professional for tax purposes. He owns a rental property and he has a $10,000 loss because he can't utilize that. If you make $150,000 or less, you don't have to attain real estate professional status, but he made too much money. So he's got this locked up loss. But because he worked with a tax coach, he knew how to maintain great records and was able to prove he materially participated in his rental activity because he spent 500 hours managing the rental with the appropriate and documentable activities. As a result, it unlocked his loss. So you must keep contemporaneous. I love that word. That just means it has to be at the time you do it. So when somebody comes back and does a mileage log later, if the court finds out you do that, no, you need to be doing it as a contemporaneous means as it's happening. So that's one good way to be bulletproof is to substantiate your real estate professional status claim. In recent exams, the IRS has been challenging some of the activities that would be in your log of 750 hours. So sometimes auditors throw out things that typically were accepted in the past. But for example, if you have to document what you're doing, it has to be develop or redevelop, construct, reconstruct, acquire, convert, rent, lease, operate, broker. There's a list. And so those are what define a real estate trader business. And so you want to document when you're in those activities if you're wanting to prove that you. So let's see if that's on the next slide. So this is something that's determined on a year-to-year basis. So it's not like you can get it and then say, oh, that's me for the rest of my life, because there's that measurement of hours each year. A fellow tax coach, she had a guy who had property in Egypt, and he logged all of his flight time. No. So, it seems reasonable. He's flying to Egypt to look at his property, but that was thrown out. So I guess the point is write it all down so that they have something to throw out. You know what I mean? Don't lie about it, but
I totally agree. The more you can put into your taxes, the better off you are, because you can always, they'll kick out a lot of stuff. They'll make you get rid of a lot of stuff.
Right.
And so the more stuff you have, then they're gonna make you get rid of stuff anyway.
Right.
You know.
You can, if you have rental properties with losses, because you have to meet that hour test per property. I have a client who has 16 properties. That's not going to happen. But they don't have a loss, so we don't have to worry about that. But if you did have losses, they would all be stuck. Okay, so they're frozen. And a way you can get around that is to aggregate your properties and treat them as one unit. So you only have to put 750 hours against that entire group. That's an election that needs to be filed with your return. It is binding in the tax year. It's irrevocable unless you write in and say, oh, I'm sorry, I didn't mean to. There has to be some substantial reason for you to want the revocation. But the downside, well, that sounds good because you unlock your losses. The downside to that is when those are locked into that group, if you sell one and it had associated losses, they're stuck until everybody in the group is sold. So you just want to be really mindful, excuse me, of when that makes sense to do that, or if that makes sense to do that. And I think that's going to make it hard to do a 1031 because you can't, you can't tax-wise get that out. So being armed with the proper documentation is really the best defense against audit techniques used by the IRS. You don't want to get a nasty tax bill at the end by losing deductions. So when it comes to documenting hours, as I mentioned, you want to do more than the 750. And I already shared the story about the guy to Egypt. Apparently, he also wrote off lavish meals, and he maybe went a little overboard.
You know what I did? I learned early on, a long time ago, in regards to real estate, and all my receipts, of course, for like properties or whatever you buy for any rentals or anything like that, make sure whatever receipt you get from Home Depot or Lowe's or wherever you're from your workers, take a picture of the receipt and throw the receipt away. Put the receipt, email it to yourself. Just take a picture of it and email it to yourself, and you'll always have it. Because
especially with those heat tape receipts, because they will actually fade over time.
Yeah.
And you're like, oh, here's my folder, and they're blank almost.
Right.
So.
Yep. Yeah. I shredded a box of the wrong stuff one time. Not good. So, but that was the moment I decided I'm not holding on to receipts anymore. I just take a picture of it and email it to whatever project I'm doing. So that way I have it on my file right there.
So a little help on that as well is like with Home Depot, we've got a pro account set up, and then when the contractor goes in there, he tells the pro desk what project it's for, and so it's already associated to that specific project.
And you probably get it in your email.
And I get it in email, so it's in digital format.
Yep. So I already kind of shared with you that the client I had, we unlocked their losses at their tax rate. That saved them about $24,000.
Wow.
I offer, your results may vary. I do offer a free tax discovery session. Basically, that means that you provide me your tax return, and I'm going to look for mistakes and missed opportunities, let you know the findings, and decide if you want to work together. Always strive for at least a 200% ROI on the plan, because it is an investment for a tax plan, and the savings are X, and that ROI has to be 200%. I think that's that. So there you go. That is the end of that. How'd I do, Caitlin? Did I run us into next month?
It.
Oh, nailed it. Okay.
So I've got a few questions, if you don't mind, because they pertain to an actual customer I have right now. And so first, can I ask, what is the tax advantage or disadvantage for filing Schedule C versus Schedule E?
Well, so this is the whole, an E is for a rental property.
Right.
Okay. And a C is for a business. It doesn't have to have anything to do with real estate. A C is always double taxed, self-employment and income. And E is just income tax. Does that help?
Yeah. So, okay, let me give you the scenario and help me with some of this decision making. So I've got a customer who had some properties they bought. They weren't rented out. They were vacant. And so between him and his tax preparer, they decided to file a Schedule C on all the rental real estate that he owns, because some of it was vacant to begin with. Now, as fast forward, he goes in, he rehabs some of the properties and he rents them out. And at this point, he's only got one vacant property. He owns, I think, 16 properties right now. He's on a Schedule C. No, from my standpoint, the lender's standpoint, my underwriters are throwing a fit saying you cannot file rental properties on a Schedule C. However, that's not true. As a real estate professional, you can. And the only people that can make that designation is the IRS. As a lender, we can't tell him that he's filing on the wrong schedule. However, as an underwriter, once they make that decision, you're not moving them off the dime on it. So the most recent conversation I had with him was, hey, we're at tax time. They only need to look at 1 year's worth of taxes when it comes to this business. Why don't you make the election to move it from a Schedule C to a Schedule E, and then you won't have a financing issue or an issue getting through underwriting, because underwriting is insisting you're filing on the wrong schedule, even though they can't technically make that call. So
that goes back to, oh, sorry.
And the fact that he's double taxed on a Schedule C because he's got to pay self-employment on it, where on a Schedule E, you don't have to.
But if the property that was sitting vacant was never a rental, I don't think that's inappropriate to go on a C. His best bet is to convert, like you suggested, convert them to rentals, write it out, collect rent, and then sell them. And now he's got less taxation and a capital gain instead of all that self-employment tax. I mean, we don't have the details, but it's on a property basis. He doesn't get to decide necessarily, well, I want to do this, I want to do that. What was the intent of the property? Maybe you don't have the answer, but that might be why it was on a C. So if it's just sitting there vacant and he's rehabbing it and accumulating costs, it's just sitting there accumulating costs. And then let's say that was in 19, and then on the 5th of January in 20, bam, now it's in service as a rental, and now I can activate depreciation on all of those accumulated costs.
So can he do that on a property by property basis, or how does that work?
He has to.
He's got them all in his LLC.
That's okay. That doesn't have any tax effect. There's just for everybody thinks that, I'm an LLC, which is great. It's a liability position. It's not the tax position. The IRS disregards LLCs. And so it doesn't mean, yes, Clay, they don't recognize it because it's a state designation. So you could have Clay and Caitlin are partners and they're in an LLC. They're a partnership return. Clay's by himself, he's an LLC, he's a Schedule C or a Schedule E, or, Lane has his own, he's an LLC and he wants to be taxed as an S Corp. So, that's a whole nother, so they're kind of unrelated. When you're an LLC, you have to, either it's dictated by the activity or you have to tell the IRS, this is how I want to be taxed. That was way more than you asked for.
If 15 out of the 16 rental properties are actively rented and have been actively rented, and the 16th is just vacant, then he should go Schedule E on 15 of them and possibly go Schedule C on the one. Does that sound
it does
like an accurate?
Yeah, and the reason I'm hedging on the one that's not rented yet, because it's not in service and it's difficult to, I can't really depreciate it until it's actively a rental and I have income. And I mean, I suppose you could, but that's not how I would do it. If I was your tax preparer, I would have you accumulate those costs and then release those costs once you actually, even if you turned it into a rental in June and advertised it and didn't rent it until September, which is unlikely, but that doesn't matter to me. I just need you to have it actively rented or available for rent.
So what do you think of my suggestion for him to, because we're at tax time for 2020 right now, for him to change them to a Schedule E so that he's not going to have a problem getting through underwriting, because underwriting's used to seeing all that on Schedule E as opposed to C.
So what is he writing off? He's got him as a schedule. Is he? I am really confused.
He's not writing off. Well, the one that's vacant, he's writing that off, but the rest of them are making money.
So he's got, I don't know, $30,000 in rent. I'm just making that up. He's taking depreciation.
He is. He's got a depreciation schedule on his tax return, but I don't know if it's actually, I think it's more informational than I think it is actually being depreciation that can be used.
And that's probably true because the tax return's going, huh? This is a 27.5-year rental property. I can't be associated with the Schedule E. You're out of your mind, tax preparer. I'm thinking the tax return, the tax software wouldn't be able to connect those dots because it doesn't, it's the wrong kind of asset to go with a C.
Well, that's exactly what underwriting has said, is they've come back and said, well, listen, you can't use the Schedule C, and furthermore, you can't claim depreciation and things of that nature. Yeah, we see it as a schedule on his tax return, but you can't claim it and then count it back as income. You can only do that on a Schedule E.
Oh, yeah. But the fun part about that is when he gets this fixed up, let's just say he does, and so that depreciation report has accumulated depreciation. It's just chugging along year after year, and he goes ahead and actually reports them correctly. The IRS, when he goes to sell them, he is going to have to recapture the depreciation allowed or allowable, whether he took it or not. It's just ugly.
Oh, really?
Oh, really?
I thought if you didn't take it for whatever reason, you lost it.
Well, that is true, but he still has to pay back the depreciation when he sells them, even though he never got the benefit of the deduction.
Right. It's
recapture.
Basically, it reduces his basis in the property, whether
Correct.
he took it or not.
Right.
Okay. Yeah.
I hate the IRS. If you don't take it, I don't understand why they can try to recapture it if you never actually claimed the benefit of it. That seems odd.
Oh, you're so.
Yeah, I don't like the tax thing. That's why I would have someone do it for me, because I'm not good at that kind of stuff.
So something, is this a self-prepared return?
No, this one's actually done by CPA. And so the underwriting took a very hardline stance. I know at this point, actually, this is the second underwriter on this because we got the first one thrown out and the second one came exactly back with the same stance. I knew at that point, we're not moving them off the dime on that. I don't need to have them change. I need to have him change. And so I went to bat and said, hey, listen, and I brought up the fact that he's getting hit with self-employment tax on Schedule C that he wouldn't be getting hit with on Schedule E. And he just really doesn't want to change from what they've originally set up. But honestly, it's to his benefit if he does change.
How many years are we talking? Is this your guy that has maybe more than 3 years?
Yeah, he's got more than 3 years. But the issue is, I don't need him to go amend his previous returns. I only need him to start changing now. So if he goes and changes from Schedule C to a Schedule E in 2020, and then it keeps going that direction after that, then his ability to get financing will not be a problem. Whereas right now it's a problem.
Right. And I can, yeah, so I see where you're coming from. And I don't know this, but that makes me nervous that it is probably correct for him to change. I don't know if that's going to make somebody wonder, but you know, the IRS is so far behind, and I can't say if that's an audit risk or not, actually.
But
So.
the other issue is, okay, so in order for him to go Schedule C, he technically has to be a real estate professional. I knew about the 750 hours, and I knew about the 50% of his income. So he's a full-time employee. He's a manager of a particular business. He makes a very decent wage, and I don't believe that he makes 50% of his income through real estate. Matter of fact, I know for a fact that's not the case. So I'm already seeing he's not qualifying for that status.
Does he have a loss? We don't have a loss to worry about yet, right? We might by the time we redo this and have depreciation. I mean, that's where it's more important, is if you to release that loss.
If we capture depreciation, we'd probably get into a loss.
So maybe there's something that CPA knows that I don't. I don't know everything about everything. I mean, that just seems, you know, unless the taxpayer is, I wouldn't do it if the taxpayer, who's got it? It's like a bug on somebody's screen, Rick. And unless the taxpayer has said, I'm holding these for resale, and maybe originally. And, you know, this kind of happens in production accounting CPA firms. I think there's somebody here that could talk about that. And so there isn't always this ongoing communication between the tax preparer and the taxpayer. And I mean, I worked at a CPA firm for a decade, and I can do taxes. I'm an enrolled agent. But, you know, people thought that she was doing their taxes, and she wasn't, because we had all these people who were credentialed to do it. So sometimes stuff doesn't make it down the pike from person A to point, you know, and most people just want to have their taxes prepared, and they aren't necessarily prepared to pay for consultations, planning, and meetings, and, you know, so this stuff gets overlooked. Let's just say that. I don't mean anything malicious by that at all. It just is what it is.
Yeah, I asked the CPA recently if they could explain why they chose a Schedule C versus an E, and the explanation was just purely, in the beginning, some of the properties were vacant, and so they basically were being held, and that over time, there's really only become one that's vacant. All the rest have become rented at some point or another, and so they just decided to keep going with Schedule C. So I don't think, honestly, when I shoot that information into my underwriting, that's going to change their position. So I'm just,
which makes me go back to, if they're just sitting vacant, then they shouldn't be on an E or a C. That's my position. Once he rents them,
where would you typically hold that?
I'm asking you as the taxpayer, you are going to accumulate this. I don't want it on the tax return, because now I got to depreciate it. So, and I don't want to do that because I don't have income to offset it. So I'm going to say, until you make it available, until it's in service as a rental, and then you bring over all your expenses as a basis for the property. That's how I do it.
Okay. That makes sense.
Now, you know, maybe the next person would do it different, but I'm pretty conservative, and I don't want to, you know, I don't even, what did they write off? Did they even owe self-employment tax? Okay. Anyway, we're probably getting down the rabbit hole.
Yeah, a little bit. The only other question I had, I put in the chat box, but it's probably best if I just ask. So let's say that, like Rick and Dennis, they're currently, he's got one BRRRR that's completed. He's got a flip that's going to happen. And let's say going on in the future, they plan on, they're going to do a certain amount of flips. They're going to do a certain amount of BRRRRs, right? Should they do those in separate entities so that the IRS doesn't look at the whole picture and say, okay, dealer status for all of it? because
I kind of touched on that. Yeah, it's not a bad idea to step back and look at the big picture. Where are you going? Yes, is the short answer. And which entity? It depends.
so the reason for separation is, this is my understanding, would be anything that's dealer status or a flip, you pay capital gains at ordinary income rates, plus you pay self-employment tax.
Now
Is
you
that
pay
correct?
income tax, not capital gain, income tax rates, which are generally higher than capital gain and self-employment. So,
So if you're in a 28% tax bracket, you pay 28% plus
15.
self-employment tax.
Yeah, it's ugly.
Whereas if you hold the property, you're not paying any self-employment tax, and any profits you have after taking depreciation is just based on ordinary income tax rates.
Whatever your rate is, yeah.
So you're saving at least the 15% on the self-employment part of it.
Yep.
So if you separate them, this bucket over here for your flips, you're gonna pay ordinary income rates plus self-employment, but this bucket over here that you're gonna hold, you're only paying ordinary income rates on what profit is showing after you take depreciation.
You're hired, Kevin.
Just trying to get it all straight.
I was
So-
going to hire Rick, but he turned me down.
I told her I didn't want to take a pay cut. So,
He's no dummy.
and to complicate things, in my situation, and full disclosure, I've already met with Gene. We've gone through this. We've paid the fees to go through this entire thing, and what she has suggested makes perfect sense. And so in our situation, I'm actually got 3 separate LLCs because I have a separate business as well. And so, the frozen yogurt business is one LLC. Then I have another LLC that is just for the rentals, and then another LLC, which will be the partnership with Dennis for flips. Now, if Dennis and I, as the partnership, decide that we're going to turn around and rent some of those acquisitions, then that will end up creating yet another LLC. So it separates the ordinary income that's coming from the flips to the rental income that comes from the rents. And Clay, I saw some faces on you going like, oh my God, this is so much. That's why we have people like Jean. And this is why we hire people like Jean. Let her do all of the brain work around it, tell you what you got to do, tell you what documentation you need to have in place. And then we just follow the bouncing ball. And she saves our bacon.
Thank you.
I thought your presentation was amazing, Gene.
Oh,
I was
thank you.
anxious to get into it. So
I'm anxious to get her started on repairing the damage from my CPA.
Well, and I've seen over the years where CPAs, if they're not really specialized, sometimes, in particular because of real estate, I just focus in on real estate, but if they're not specialized on real estate, they may not know all the ins and outs. And that's where somebody who's going to be in the business for any length of time, you really got to get with the right person, because they just may miss things, or they may not be aware of certain things.
Mm-hmm. Yeah, if you came to me and wanted me to do your stuff for your $6 million retail inventory, that is its own specialty inventory, and you better know all the ins and outs. And it is hard to know everything about everything, and that's kind of what we're expected to do as tax preparers. And it's this last year has just been with the CARES Act and this thing on the December 27th and all the retroactive stuff, and it's been mind bending. So spend a lot of time in continuing education.
So you brought up something before the meeting started with regards to, is it a new program or something like that for people with employees and things of that nature?
So it really isn't. There was the Employee Retention Credit in 2020, the Appropriations Act that was passed of 2021 that was passed on December 27th of last year, retroactively opened it up for, it had closed on December, it was supposed to close December 31st, and it retroactively opened it back up to March. Generally speaking, if you were affected, you have to have employees. If you were affected by the lockdown, meaning you were locked down, you're like Rick's example where he cannot operate, you can claim a credit of up to $10,000 a quarter against the wages that you paid. And that's quarter 2, quarter 3. And if you weren't affected by the lockdown, meaning you could still operate, but your gross receipts are down by 25% on a per quarter basis, then you qualify. So it's 2 different avenues to qualify, but it's pretty lucrative.
So on that credit, how does that work? Is it you get the whole credit for that in that year, or?
So what I've done with my clients, if you're working with somebody who does your payroll, they have the opportunity to do a catch up in quarter 4 for the whole year, or for the whole period. Most payroll companies, at least the ones that I use, and I think Rick ran across the same thing, they've already filed quarter 4. So I just went onto my dashboard, said these clients qualify, and then they're going to file an amendment, and those people are going to get a check. So if you work with a payroll company, I would circle back to them.
I think Rick is probably in this group the only one that would be affected by that.
Well, I know you have employees, but if you haven't had the loss in income, then you're right, you wouldn't be eligible.
Well, my employees are a little bit different. They're technically the employees of the company, not myself. And so.
Oh, Geneva. Okay, got it.
Yeah. Geneva.
Yeah.
Everybody's an employee of Geneva.
Yeah.
Even though I'm 100% commission, I'm still W-2.
Right.
And so my employees are technically not my employees. They're Geneva's employees.
Right.
We work for Geneva under the branch of Kevin.
Right. Okay. So anyway, then scratch all that.
Well, I find it interesting though, because the more you are up to speed on that stuff, questions, you never know where questions are going to come from when it comes to a borrower. So
does anybody here would anybody here raise your hand? Would you be interested in an opportunity zone presentation?
Funny that you mentioned that.
Yeah, Rick, what?
So funny that you mentioned that, because one of the properties that came across my desk a couple of days ago is actually in one of Aberdeen's designated opportunity zones. Dennis, that was the one that I said needed a lot of work, but it was still in the opportunity zone, even though it's in the flood zone. But anyway, there's some. I understand that there's some really good things on there, but there were some questions that I had on it. So, yeah.
So just a quick overview. An opportunity zone is a federally declared area, and you can defer and reduce your gain. If you have a capital gain from a sale of stock or dividends or a house, you could defer and eliminate some of that by, it's a process. It's not, quick and dirty, because the IRS has to make everything complicated, but you can defer and eliminate some of that gain. and there's a timeline that has to happen. Anyway, so that's the overview.
And so the question that I had on it was, how long do you have to hold the property before you dispose of it?
I'm thinking it's like 10 years,
Oh, that long?
7 to 10. Stuff happens at different intervals, and at 5 years, 7 years, 10 years, and that's where the deferral / elimination comes in. So maybe that's not good for your timeline.
So if I'm understanding that correct, let's say I had a $200,000 in a 401k. I wanted to pull it out of the 401k, and I'm going to invest, say, all of it into this property that happens to be in an opportunity zone. The capital gains I would have normally paid on the profits that I made off my 401k can be deferred if I invest in this property in the opportunity zone. Is that simplified?
I'm going to say no, because a 401k is a tax preferred investment. So you put that money in pre-tax. When I said, I mean more like you bought stock in Amazon, and then you sell that stock and you now have a gain. So that's a better definition of the gain. But generally people have a rental home they're going to sell, and that's how they're going to defer and eliminate some of that gain. So
if Lane had a windfall from Tesla stock and he decides to sell this Tesla stock and invest it in a property in an opportunity zone, he could defer that gain that he would have had off that Tesla stock by this property.
Right. And it's I shouldn't say because it's from memory, but there's a small portion that is eliminated. I want to say 10 or 15%, and then the rest is deferred. Anyway, it's a process, and maybe it's not anything, maybe it's too complex for where people are at, or it's not that interesting, or, I'm just going to put that out there for Caitlin. And if she says, oh, I just got the thumbs up. It's not going to be next month, you guys.
I have to do this now. We'll talk about it and,
yeah, okay.
Get a better idea. And it's not going to be next month, but
no, it's probably going to be in May after April, tax season.
Yeah.
So, okay.
So yeah, we'll look into it.
Okay.
So you look like you're pulling questions. I just want to pull questions.
No, not really. This is all just, out of context for where I live financially. And so, but it all makes sense, right? It all makes a lot of sense because it's just a different way of measuring your checks and balances buckets, right? There's just a lot of different buckets and a lot of different way the pieces can get to, because it's checks and balances, it sounds like. And it's all about losses and gains and how you can write stuff off. And I knew all of this, but I'm just realizing that, I just have to pay people to do this job.
Yep.
Just go watch a YouTube video, Clay. You'll be fine.
No, that'll probably waste the next 6 months of my life. No, because it's not going to be one. It's going to be 900, and then I'm going to wonder what happened. And it'll be bad.
Where did I start this? Because now I'm in YouTube hole.
And so, you're not stupid, Clay. You're picking up on the fact that this is not. It can get complicated. It can be navigated. You do have to navigate it, and.
So in all honesty, like it kind of goes back to what Lonnie said, where this is about what I don't want to learn everything. I'm not going to learn everything.
Right. Exactly.
Right. So, I'm trying to come up with a nice way to say, this is not my bag. I'm not picking that up. Because there's certain skills I want to have, and these are things I need to participate in or will need to participate in the future in the next couple years. But absolutely, this is about the people in your network and who you know and how you can leverage other folks' knowledge, flat out.
Like if you came to me and wanted me to do international tax, I would refer you to one of my colleagues.
Yeah,
So,
exactly, exactly. And that's good to hear because that means we're all kind of in that same mindset where we
Mhm.
all have what we do, right? And yeah, absolutely. I mean, technology is my wheelhouse and that kind of stuff. And so, yeah, I'm trying to leverage that to make wholesaling easier for myself, right? You know, do what you know to learn new things.
Kevin,
Okay, any other questions for Gene and the mountain of knowledge and the 10 million different directions questions can come from?
yeah, we'll definitely be having her back, and all of our prior meetings and this meeting are going to be on YouTube. So if you look up, perfect for you, YouTube University. If you look up Kevin Romines on YouTube, all of our past meetings are there. So it's got a lot of content, and they all have fast forward keys, so that way you'll be able to skip past certain sections.
Right. Well, I think it's been a great meeting, a lot of good content, a lot of great information. So thank you, everyone. And unless anybody has any other questions for anybody, I think we're going to wrap it up.
Okay.
Thank you, Gene.
Thank you.
That was awesome.
As Dennis did slow-mo.
So
yeah.
I have this calendar out for the rest of the year because I'm on top of it this time. If you follow us on South Sound Real Estate Networking on Facebook, then you'll see all those. You'll get the posts prior and reminders. We're also on Meetup, LinkedIn, and Bigger Pockets. If you find Kevin on Bigger Pockets, it's a great resource to like get your questions answered. And like I already said, we're on YouTube as well. That one's super important, and all this stuff will be up on Friday. So the video and the directory will be out on Friday.
Awesome.
Thank
Right.
you, Caitlin.
Of course. The next meeting is February 9th. I don't know if I said that, but yeah.
February 9th, and
February 9th.
that's a Tuesday, I assume.
Yeah, they're all Tuesdays. I'm shooting for the second Tuesday of every month. We're gonna try and do an in-person meeting eventually whenever COVID decides it's done. And with every in-person meeting, we'll also have a virtual meeting. So we'll kind of get both sides of that.
So we'll double up.
Yes. So we get everybody because we have a lot of people, like some friends on the West Coast or the East Coast that want to join that aren't able to right now. So it'll be good.